Markets rise and fall. Technologies change, but the principles of smart investing, they stay the same. Whether you're a seasoned investor or just getting started, these timeless tips will help you build long-term wealth and avoid common pitfalls. So, first things first. The rule number one is always let your money work for you. Because as we keep our money in the bank account locked away, thousands of dollars or euros or whatever currency you have, it will lose money or it will lose its purchasing power over time. Now, let me explain what I mean with that. There's this concept called inflation, and inflation eats at your savings every year. This is because there's more money being printed all the time, and therefore the value of your money keeps decreasing over time because as the supply increases, the value of each dollar or euro that exists decreases because there's more of it and therefore it goes down. So, like if you imagine like your grandma putting, say, $300 under her mattress to buy a TV in the future. Today, the TV costs, say, $300, but next year, because of inflation, that same TV now costs $315. So her $300 is still under the sofa, but now it's not enough to buy that TV that used to cost 300 as well. And that's how inflation eats away at your savings, and it makes money worth less over time because the prices rise. You still have your $1,000 in the bank account, and that will just be decreasing in value over time. So it's really, really important that we put our money to work and we invest it in a way that's intelligent so that we can avoid losing out on inflation. And it's typically meant to be around 2%. But if we say invested in an ETF at an average growth rate of say 10%, then we are increasing our money over time and we're not losing out to inflation. Um, so your money should always be working for you because at the end of the day, you can be the money machine or you can have a money making machine, You can work hard and make more money, but at some point, ideally you'd love to retire and you'd love to have a machine that works for you. And if you have a million or half a million or a couple of 100,000 even in ETFs that are working for you, that are making you money without you having to do anything about it, that's like called having a money machine because that thing just does its work for you. And this is where compound interest will be really, really key. And we'll show you that in a moment, what it means, because the earlier start investing, the better. As we've explained in the why investing video as well, you will be able to grow wealth passively over time because, there's this thing, if you say invested $100 and you earn 5% on that in the first year, you now have $105 after 1 year. But this will compound over time because now in the next year, you're earning interest not on your original 100, but well, not just the 100, but also on the $5 extra that you made in the first year. So now you earn interest on $105, giving you after another year $110.25. And this is where the compound interest really becomes interesting because you will be earning interest on your interest, and that will just compound over long time horizons and making you a lot of money in the long run. And just to kind of illustrate that, I think we have this graph here. If we have that, you would, after normally 20 years, have, if you invested $100 every single month, you would have over to 20 years with no interest. If you left it in your bank account, $24,000. And you can see the insane difference here after 20 years. You would have for a 5% interest only, which is, very achievable. It's a very low interest rate that you can earn. 41,275 and 10%, you would have 76,570. So you really see how it's important, how you would be earning for doing nothing at all, really a lot more money if you were to just invest it intelligently. So that's just to show you that. All right, so the next tip that is really important is to properly define your goals. And this is a way how I frame my goals, having invested for a long time, um, and it worked well for me. But honestly, if you have another way of doing this and like you prefer to visualize your goals in a different way, honestly, feel free to do it. Um, it's totally up to you. This is a way that has worked for me when it comes to financial goals, and I definitely recommend you find a way that works for you. So, I like to write down the goal, say, financially 5 million. I want to have it achieved by a certain date, exact date, and what you aim to do to achieve your goal and visualize how you feel when you have already, achieved it. And I think this works really well is because you have a specific goal in mind, you have a vision, you know what you will do to do that, to achieve it, and how you will feel afterwards. So already kind of like grateful that you've already achieved it. It makes it more real, I think, that you have achieved that goal. So this is something that I've used for a long time and it has worked well for me. And I would definitely then, yeah, recommend when it comes to a risk profile to consider what you are willing to invest every month because you should not invest more than you are comfortable with because it will not make you sleep well at night. The risk will be too high. If you go through the account management videos, you will see that it's really important to have like a saving account, like, a emergency deposit so that in case something goes wrong, you have money that will be able to pay for your emergency situation for 6 months of living expenses, as we said. So, don't invest more than you can afford and see the account model, start small, don't, go crazy and just, invest all your money into some random thing that someone told you. Um, do your own due diligence and define your own risk profile. Start small and, act today. I think I would, yeah, think about it. Don't rush it, obviously, but I would definitely like you're not going to be able to reap the rewards if you don't take action. So I think this is what I really want to emphasize with this slide. So this one is really important. So practice long-term investing. You know, dollar cost averaging is a very, very key point, and this is something that we'll explain in this video as well and show you how to automate this practice so that you don't have to sit there every month and do it yourself, but you can actually have it all done for you in an automated fashion. And it's a very effective way to invest long term into the market. And because it is likely that you are not Warren Buffett or CC executive of a large company, you might not have the insider views of what's happening in Wall Street and other stock exchanges around the world, and what happens in the inner workings of a company to really be able to tell whether that company will perform well or not well. And at the end of the day, it's very, very hard to predict, even for these people. Um, and that's why timing the market is super hard. It's super stressful. And it's honestly, if you don't know like much yet and you're just starting out in this field, um, a waste of time, in my opinion. And it might end up making you lose money. I mean, you can try it. You can learn from my mistakes. I've, tried to take advantage of some stock hypes here and there in the past with small amounts still. Some of them decreased literally by 90% over the next like couple months. And I saw this thing increase like significantly. And I thought, oh my God, like, this lithium stock or whatever is going to go through the moon because EVs are being sold like electric cars and they need lithium to power them. So it's a no-brainer, right? We're on the energy transition. Let's buy this lithium stock, whatever. It decreased in 90% or something over the next couple months. So, that's not to say lithium stocks are bad. Like there's definitely good ones. But I mean, what we're trying to say here is just, don't risk like losing your money for stupid hypes if you could easily, over the long run, just make more because you can always and also if you stock pick and you don't know what you're doing, like, maybe sometimes you're right. Okay, damn, like you make, I don't know, 200% on your money or something. but then you think, wow, this is insane. Like I can make so much. And then you put a bunch of other investments in, and then you lose on some. And then, in the end, you would have just thought, like, damn, had I just put all this money into ETFs right from the start, I would have had consistent growth, and then I would be way better off than, me being right several times on a stock pick, and having lost many other times. So that's why set a monthly amount and it will help you mitigate your risk. So this is the next point, like dollar cost averaging. Why do we even do this? Why don't we just, you know, use our $2,000 that we have and just straight up invest it into an ETF? Like, honestly, don't get me wrong, you can do that. It's not a bad thing to do that. I'm not saying don't do that. I'm just saying, dollar cost averaging might be more intelligent for you to invest more long term. And let me explain why. Because the stock market goes up and it goes down, goes sideways, it changes all the time. And sometimes it goes down for several years, and sometimes it goes up for several years, and it's very hard to predict what will happen next. And that's why we don't want to ideally predict what's going to happen next. We just want to like invest safely and like take advantage of the long-term growth. And because the risk is that if you say have 10,000 and you say, I want to invest these 10,000 and you're putting them into an ETF, that after that shortly, let's say you buy it all at once. You buy an ETF all at once, 10,000, and you have like this new one. The chances are that it will end up decreasing for several years until it will start increasing again. And then wouldn't it have been nice if you had bought when it was decreasing and you bought it at a lower price, getting more of that? And then when it went up, you would have had even more of your 10,000 already. And, dollar cost averaging basically tries to average out the price over time. Now, let me show you how that works. I'll just quickly go out of this and I'll show you on this SPY curve here. This is the top 500 companies, S&P 500, for example. And, you see the prices going up, and then here during COVID, for example, it went down, and then it went up again shortly after. There was this big boom afterwards as people started to realize, like, some economies, some sectors were really boosted. But then, imagine now here, you're thinking, wow, like this has been really going well. Like my investments are going super well. So let me pump 10,000 into this ETF or whatever. And you buy it here, you know, you would have had to wait for 2 years until you actually see your ETF in a positive again, you know? And the risk like that is all the time that this thing could suddenly decrease and then you might lose money over time. So it could have been very smart for you actually to instead say, if you just wanted to start here, every single month buying $1,000 instead over a 10-month period to buy this ETF for $10,000. Because then, or even if you started here, you would have had here, you bought one, two, three, four, five, six, you kind of get my point. Okay, let's say we started here, I don't know, like 1,000, 2,000, 3,000, 4,000, 5,000, 6,000, 7,000, 8,000, 9,000, 10,000. So here you would have then, bought it for expensive. You would have bought it for cheap. You kind of see my point, like your price average would have decreased because you would have bought it for expensive, but you would have also bought it as it went down. So you would have definitely saved some money. And while obviously, I don't think it's wrong to just buy 10,000 because I mean, this thing is diversified and you don't want to sell it in the next year. Like, you keep this thing for 20 years, it won't make a massive difference. But if you say invest every single month of your life, 100 or 200, you will, take the ups, the downs, but in the long run, this thing is just going up, this thing is just, you see the trajectory is just, it just keeps going up. And so obviously you want to be diversified, but it's really good to practice long-term investing um, and to be able to take advantage of that long-term growth over time. So this is what we basically try to explain with that. Um, and so, set a monthly amount and then over a 5 or 10 year horizon, these ETFs will tend to grow, especially the more established ones, like the biggest companies in the US, they're not going to go anywhere anytime soon. They might decrease in the short run, They might, you know, face some challenges sometimes, but these companies are so big, like there's very little that can go wrong. Um, as well as like our other markets, as we suggested in this portfolio video that is going to be within this course as well. So we'll have one video showing you the different portfolios, and these are very safe ETF options that you can choose that will tend to grow in the long run. And there's not really much that can go wrong when you invest into those. So stay attuned for that. Um, and that's why, do it like dollar cost averaged, and then there's an automated set and forget way to do this. And we'll show you exactly how that works for two different platforms, depending on, whether you are work in an international setting, like non like in an international like countries around the world, most of them you can trade with interactive brokers, as we have explained in another video. And if you are in an EU country, you choose interactive brokers that will allow you to do that. And we'll show you how to basically set automated set and forget trades so that you don't even have to do this trade manually yourself every month, but that you can instead just rely on that being automated, done for you. That's the compound interest we showed you. Okay. All right. Now, the next key thing to consider is to diversify your portfolio. You know, do not put all your eggs into one basket. This is really, really important because you will be able to spread your risk this way. And, in this course, we're teaching you about ETFs. And ETFs, as you know by now, are inherently diversified because they include stocks from 100 different companies or hundreds or even thousands of different companies. They're diversified across regions and, sometimes even diversified across asset classes. Um, and this is really, really beneficial because you want to make sure that you are diversified to mitigate any risks, that exist in this world. So let's go through the different types of diversifications you can undertake. So the first one is regions. You want to invest into many different regions across the planet because if a crash occurs in one country, you are going to be less vulnerable. Let's say, for example, you invested all your money in the US, and like let's say you have all the big US companies and you think, wow, this is good, they've been growing so well. Well, what happens if there's a big banking crisis or whatever going on suddenly in the US that you didn't predict? And then suddenly your stocks will tank. It's good to be diversified across different countries and different regions so that when that happens, you are less vulnerable to that decrease in price that will happen at this point in time. And so that's really, really important because if you don't do that and you put all your eggs into one basket, if one of these like sections that you or one of these factors that you're involved in does badly, then your whole portfolio will suffer really badly from that. And that can be really frustrating if you think that, your money's going up, but actually it's going down because you haven't managed your risk appropriately. You also want to be diversified across sectors. You want to invest across many sectors because if a sector underperforms, you are less vulnerable. It's the same thing. And that could be, for example, if you invest all your money into tech stocks, well, there might be a kind of, bubble forming because there's over enthusiasm about the tech capabilities, then your portfolio will suffer badly when it comes to the decrease in prices because there's been some bubble forming that has bust. Like for example, there was the dot-com bubble in the past where there was a big enthusiasm about new internet companies that had like dot-com and at some point the prices has all gone into the cellar because people were just over enthusiastic about it and it wasn't really driven by the economic value of it, but more about the mass psychology of people just buying stuff. And then, the bubble ended up bursting. It was not a good investment to put all your money into that. So it's really important to stay diversified across sectors as well. And across asset classes is another good one because there's stocks. Just to tell you what an asset class is, this could be like stocks, metals, or Bitcoin, different types of investment products that exist. And because if same thing, if an asset class underperforms, you are less vulnerable. It's all about making yourself less vulnerable to external changes that you cannot control, but they will impact financial markets. So you want to make sure that you invest broadly into different things so that you avoid these mistakes. And that's why, in this course, we're going to talk to you about ETFs and why ETFs should be the things that you can invest into to get started. And the reason for that is because they are inherently diversified across regions, across sectors, maybe not across asset classes, but then you can think of, some other things to invest there. But you're going to be diversified across regions and sectors, which is already really good to be able to mitigate any risks in the long run. Next up, want to talk to you about which products or services you morally support, because this will impact your investment decisions. Because, in this course, we're going to teach you about the ETFs, like big ETFs that you can buy that are established, that, passively track the market, that are diversified, and, your money should reflect your values. Because at the end of the day, there might be companies in there that you morally do not agree with, and you want to, let's say, not buy stocks from a certain company that does certain things that you disagree with. And so, what sustainable investing allows you to allows you to do, is to say exclude certain industries from your portfolio. And this is a very useful tool when you look at these big ETFs that we teach in this course, because you can consider what you want to have in your portfolio or what you don't mind having in your portfolio, and then actively choose to avoid certain investment products. And more about this is in the sustainable investing section of this course. So if you want to learn more about this, but basically you can then, decide to exclude fossil fuels, exclude weapons, exclude alcohol, tobacco, genetically modified organisms, you name it, anything that you might disagree with, you can choose to exclude from your portfolio, and not necessarily at the expense of growth of your portfolio. So, there's investment options that exclude things that still do really, really well, almost as well, or even better than the normal ETFs that we have, the really big ones that we're looking at in this course. Um, so definitely worth looking out for, because you want to align your money with your moral values. Also, this is a really important thing because it's a very rapidly increasing field. People are becoming more and more conscious of environmental damages that are occurring around the world, and therefore looking to align their money with that moral values. And therefore, the sustainability funds that have been developing, where you exclude certain businesses or invest into certain themes, have tripled in the last decade. So there's significant growth there. There's a lot of money, and the money is really shaping, this in terms of creating a better world for people. So it's definitely worth to consider as you go about designing your portfolio. Now, this is a really important slide here, because we really want to stress in this course, as well as in general, investing with a long-term mindset is really important. Buy and hold and keep your investments for a long period of time. Investing in ETFs is not an overnight get-rich strategy. You want to take a long-term approach, because you can try to stock pick and buy, a stock that someone told you about, or, and hope that you times three the value overnight. But at the end of the day, it more times than not, it could fail unless are the CEO of a big company and you have the inside view of what's happening there, which, I assume in this case, most people aren't. And in that case, you want to invest with the market rather, and make sure that you take advantage of the increasing value of stocks over time, of the market, and therefore buy big ETFs with hundreds of and even thousands of companies in them, and be diversified that way. And so it really allows you to take your time, invest over 10, 20 years or so, and pursue other things in the meantime, because honestly, this doesn't take you a lot of time at all. Like once you have the system set up, um, you can, set it up and spend maybe an hour a month max. Even 10 minutes a month or so would be fine, to be honest. You don't have to constantly check your investments. I think honestly, for me, it's a waste of time. I don't check my investments every day or every month, even sometimes, because I know that in the long run, it's going to be okay. Um, and so it's something that requires very little time. I think that doesn't make it so that you shouldn't educate yourself further in the meantime. I think education is the best investment you can do in any case, like to learn more about finance, about investing, and so on. But you don't have to use a lot of time to, be scared and like think about, oh my God, is my stock this that I pumped, I don't know, 10,000 euros into going to triple in value overnight, or am I going to have nothing after this? You don't have to be worried. You can put a little bit in and you can do that consistently and you can reap the rewards in the long term. And also there's advantages for doing that because many countries have give you tax advantages actually, because actually speculation is taxed in many countries. And I know that in Australia, for example, unless they've recently changed it, um, you will get, I think, a 50% um, reduction of taxation of taxable income on your stocks that you sell if you keep it for longer than a year. So let's say you buy a stock and sell it for, let's say you make $1,000 gain, you would have to normally pay, say, $500 of that to the government in tax. But if you keep it for over a year, now suddenly you only have to pay 250. And so you get to keep more money. I think in Belgium, it's also uh, reduction of the capital gains even potentially reduced to zero, I think, if you keep it for longer than a year. Because if you're speculating, if you're buying and selling a share within, a few days or weeks or even months, not anything less than a year, can be considered speculation. And then they will tax you on that. Whereas countries want you to invest into the share market in the long run to boost company finance that they have access to grow their businesses, which is in the interest of the government, and therefore they give you tax advantages for that. So it's not just a smart approach for you to not be stupid and lose your money because you're going with the market, but it's also advantageous from a tax perspective, because you can make more money and get to keep more of it and don't have to give it to the government, not as much for that reason. But obviously, do your own due diligence, check the tax requirements in your own country. Don't take my word for it. I just know that many countries have this kind of system in place. Maintain your emotional discipline. This is very much in context of the last one, the long-term investing approach. Because when you see that the market is crashing, do not jump the cliff. You see the cliff, don't jump, because with these safe investments of ETFs that invest into the broad market, there is no it will never be so that it will crash and it will never recover. It's never like this. It will always recover in the long term. And if you sell right when they are very low, you might be selling at the worst possible time. And you might be losing a lot of money for that. And if you had waited, let's say, another year or two, you might have had all your money back and even more. And this is a long-term game. There's going to be crashes all the time. And it's good for you to maintain your emotional discipline and just stay invested, stay strong, and have a system in place. Take the emotion out of the investing. It's a system that you have. And the system that we teach you here is going to be composed of, dollar cost averaging every single month, no matter what the price is. If the price is up, down, left, right, sideways, if the market has crashed, I don't give a shit. It doesn't matter what the price is doing. You just invest every single month. You don't sell when the market crashes. You keep the investment for a long period of time. And that's basically it. You know, it's really that easy. You must be patient and you must not be, you know, guided by your emotions that say, oh my God, we are in an energy transition. We should buy lithium mines or whatever, or we should do, whatever. My grandma told me about last night when she read the newspaper that, apparently oil is the big thing now. We should all buy oil stocks. Like, do your own research and, you know, maintain emotional discipline with a strategy that you go with. We're going to teach you one, and you have one, and just go with it. Stay disciplined. Stick to your rules that you set for yourself. Every single month you invest. Doesn't matter if the price is up or down, and you just stay invested for a long time, and you will reap the rewards for it. So in terms of the bonus rule, I think the bonus rule is to just start because I have myself been in the trap of analysis paralysis. And it's very common because there's a lot of ETF options to choose from. There's a lot of brokers, there's a lot of tips, a lot of news. There's so much information. And honestly, sometimes like it gives me a bit of anxiety because there's so much information out there, you don't know what to go with. And it can be very overwhelming and it can make you kind of, paralyzed because you think, oh my God, like I want to learn everything before I start. And I don't want to make any mistakes. And you know, it's so much stuff going on. But to be honest, the best thing you can do is just start, as I said here, because the sooner you start investing, the earlier you get to reap the rewards of it. And when you choose a global ETF, there's very little that can go wrong in the long term. You know, there's not really much you can do wrong here. Yes, you might adapt your strategy over time as you learn more about this topic, and you might, you know, adjust the type of ETFs that you buy because of things that you've read or things that you've learned to improve your strategy. But, I've done a lot of research here and a lot of experience here. I've bought many stupid stocks. I've bought many intelligent stocks. I've bought many ETFs, and I know what has worked for me in these past years that I've been doing this. And, you know, you can obviously learn your things and like add to that and improve it in some way. But, um, it's important to do that is just to get started because learning about something is one thing. Actually doing the thing is another thing. And you make assumptions as you learn, but when you actually act on it is when you form a very deep understanding of the topic. And when go about investing, you will learn better and you will make mistakes and you will, iterate and make it do it better. In this course, there's not really much you can do wrong um, implementing the things in this course because, these global ETFs, maybe you'll decide, oh, actually, I don't want to buy ETFs at some point. You can just sell them and you won't have lost a lot of money because these things tend to hold their money, their value very well in the long run. And so it's really important to just get started, learn, reiterate, improve. But I mean, yeah, maintain your emotional discipline. Go with a system that works for you, like the one that we've laid out in this course, and get going, get started. Continuous learning is key.